our next thing. All right. So looking at everything all across the board, another way to basically look at it, which is, how a lot of the markets can be interpreting it, is that the market just received a clean dovish PCE signal this morning. And I actually ended up receiving something more complicated. And the way that you would put it is basically that inflation is no longer accelerating aggressively. So that's why understanding what these percentages means a lot. This is acceleration rate. So even if it was 0.1%, that still means that inflation was still increasing, but it was increasing at a 0.1% rate compared to the previous. This means that it's increasing at a 0.2%. So inflation, for example, is still accelerating. It's just not accelerating aggressively, but it is still too high. So if yesterday inflation was sitting at 3.3%, and then today we got to jump up to about 3.4%, 3.5%, then that is still a lot further. That is still inflation moving a lot further from that 2% target that central banks have. So headline inflation remains sticky. Private domestic demand is still stronger than the 1.5% headline GDP headline is suggesting, and the Fed therefore has no urgency to rescue the economy. That does not mean that you're going to see further hikes or that you're going to see further cuts. So that's not a clean stagflation conclusion that we're looking at, right? Instead, what we have is sticky inflation, resilient underlying demand, and soft July consumption. So for markets, it creates what you would call more of a hawkish hold regime. And the Fed can probably stay on hold near term, as we just looked at, but another hike still remains completely alive. So that is why the bond yields and the dollar are moving higher, even though core PCE matched our expectations. Now, Nvidia has to trade tonight inside of that macro environment, which is the most important thing, because Nvidia no longer gets the benefit of a dovish PCE tailwind here anymore. When we're looking at very specifically this article too, we looked at core PCE pushing up 0.2%. We saw that it's sitting at 3.3% from a year earlier, but both basically as expected, right? So that is good relative to an inflation reacceleration. But that 3.3% is still materially higher than the Fed's 2% objective. And that 2% number is what majority of the Fed members have very explicitly said. So this number does not tell the Fed that, mission accomplished, we're good, we can ease out. Instead, it tells them that, inflation is not worsening dramatically. It's not our biggest nightmare, but we're not at the target. So that provides support to the FOMC members who were talking about, if we continue kicking the can down the road, we're going to have to, still address the issue here. We're still going to have to increase the interest rates, but we're just going to have to do it more aggressively later on. So that is the difference that we're looking at. The headline PCE stays at 3.7% year over year, which is roughly against 3.6% expected. That is not the core PCE. I'm talking about the headline PCE. That is the part of the report that the market is basically reacting to here. Headline inflation is still elevated, partly because the economy has been dealing with the energy shock from the Iran conflict. So that is the key thing, where the Fed officials want to wait for more signs that inflation pressures from the Iran war are receding. The headlines that we're getting, where even if you come to, financial juice, where Trump is suggesting 22 ships have passed through the Hormuz last night, the Strait of Hormuz is functioning, all that stuff, you come back, the conversations are really just between Iran and Oman. The U.S. is still not part of it. The U.S. is obstructing the process, causing progress to be delayed instead. So again, reading in between the lines, not just reading the headlines or reacting off of tweets or whatever that is coming from Trump. So even though oil has now, collapsed from the recent high levels that we're looking at, that is also another reason why we're getting that push from the 80 mark that we had mapped out from our market update. So we've still in a downtrend. We're still in a downtrend from the peak that we saw in earlier 2026, but that 80 mark is a very significant level for gold here at the moment. And today's PCE is telling us what happened in July. It's not telling us what's happening right now. So today, oil sitting at $80 will matter a lot more for future inflation prints than this morning's historical numbers that we're looking at. So the oil's decline is potentially disinflationary going forward. It does not erase this morning's sticky inflation print, but this is what matters a lot more if you are able to piece all these different things that we're looking at together, do the cross-asset analysis, and really understand the type of data points that you can already expect to see. If you were able to see what oil was doing, the yields were doing, and the DXY and all the different assets, the risk-on, risk-off sentiments, we already kind of knew that the data points today were going to come in line with the expectations. One closely watched service measure, also excluding housing and energy, rose around 0.3%. That is a super core detail, which is very important that we're looking at. And one major contributor was a 5.6% jump in the portfolio management and the investment advice prices as well that we're looking at. That is the biggest increase in that category in about a year. So the reason that is so important is because policymakers have been particularly concerned about services inflation. The economy split between goods and services side, especially on the manufacturing side, right? Goods inflation can move very quickly. It's the inflation on the services side that tends to be stickier because wages and labor cost will matter a lot more. So I don't want to overstate just, one portfolio management category. That would be just kind of noisy, but understanding how does that fit into the overall inflation for the services side. The BEA is actually changing some PCE methodologies beginning next month, including parts of legal services, software, and investment advice measurement. And that changes that many economists will expect will mechanically lower the measured PCE somewhat as well. So that's another thing that we need to watch out for as we start to see more PCE data points going into the next month and going forward. So at that point, we're going to have to distinguish between real inflation improvement versus the measurement changes. If PCE falls next month, partly because the methodology has changed, the Fed is going to know that as well. So that's something else that we need to know going forward too. Now, also looking at the same exact article, and the inflation adjusted consumer spending was flat for the most part going into July. That's quite weak. But immediately that doesn't mean that, real spending is flat to consumer is now becoming a little bit weaker or that the consumer spending is collapsing. The real goods spending fell about 0.8%. Let's continue down here. Yeah. 0.8%, while the inflation adjusted services rose about 0.3%. And Amazon moved Prime Day from July last year into June this year, meaning that some spending that normally would have appeared in July was probably pulled forward. So that's important because that creates timing distortion. Consumer behavior also looks increasingly price sensitive. Walmart and other retailers have been telling us that consumers still spend, but they're hunting for value at this point. So that is slowly slowing down the discretionary demand without necessarily signaling a recession. So those are some key things that we, again, need to know just reading between the headlines. There's also another important positive consumer detail here. The real disposable income rose around 0.4%. Right here. That is the strongest monthly gain that we have really seen since January. There was one in about April, but after that we hit 0.0%, which was pretty much at the same exact pace as the previous, and then we had June hitting the 0.7, again kind of just comparing that to wherever price was initially sitting at, and now we got a nice boost up to 0.4%. And the personal savings has also risen up. Let's see, let's come back here. Personal savings has also risen back up to about 3%, a 4-month high. So consumers are rebuilding a little cushion for themselves, and that makes today's combination even harder to call stagflation. So do you have weak July spending? Yes, but disposable income has also improved, and savings has improved. And then GDP tells us that quarter two private demand was considerably stronger than the headline is suggesting. So coming back to the different scenarios that we're looking at yesterday, we're pretty much in line with the expectations when it comes to the headlines or when it comes to the data points. But reading what's happening between the lines is already going to give you a forward guidance of what you're going to expect with Kevin Warsh saying. My prediction is that Kevin Warsh is not going to give us any signals that the Fed is going to hike interest rates just yet. Instead, there's going to be a signal that we are holding interest rates going into September, and that after that, he's going to say something along the lines of, well, as more data comes in the market, it's going to be pricing that in real time. He's not really going to give us too much. Just looking at the data points, just reading between the lines here. Even based off of this, the second estimate of quarter 2 GDP stayed exactly where we expected, 1.5% annualized versus the 2.1% in quarter 1. So on the surface, that looks like, slowing down. And it is slower, but when you look underneath it, you have consumer spending, which was revised up. Increased at 3.4%, stronger than the initially estimated at 3.2% gain. Non-residential fixed investment climbed at 8.5% pace as well. Consumer spending is more than 2/3 of the economic activity of the U.S. economy. So the household sector was actually stronger during quarter 2 than the first estimate was really suggesting here. The non-residential fixed investment grew at 8.5%, which is also very important. Businesses are not acting like they're already in a recession. And part of that investment is the AI, the data center build out that we're going to talk about with Nvidia as well. And I also talked about that in detail in the market update. So if you haven't watched that again, just go back and watch that too. Final sales to private domestic purchasers rose about 4.2% in the second quarter. That was revised up from that 3.9%. And that's the strongest in more than 3 years that we're seeing. So this measure strips out some of the noisy GDP components, the government, the inventories, the net exports, and really it's asking, what are U.S. households and private businesses actually buying here? The answer in quarter 2 was basically a lot. And that is why the Fed simply cannot look at the 1.5% GDP headline and say that growth is collapsing and we need to stop worrying about inflation, because the private economy underneath it is substantially firmer. So we fully understand the data points that came out today. What does that mean?
Yeah, I'm good for me.
Okay. Now translate that over to what's happening with the treasuries. So when we look at that, again, just want you guys to fully understand what's happening here, because this is going to be very important going into Nvidia and then also going into Jackson Hole and preparing for the next interest rates that are going to be coming out, because now we have swing trade positions that are going to be opening up all across the board for us, as long as you understand what you're looking at. Now, when you look at the 2-year, that rose to about 4.22%. Basically rose about 4 basis points from where it was sitting at previously. The 10-year rose also from that 4.62% up into 4.66%. The 30-year rose from that 1.16% up closer to 5.18%, slowly starting to catch up to the 10-year and the 2-year as well. The dollar has strengthened as well from that 99 mark with that nice bottom wick rejection and then that push back up. If you look at Euro USD, the US dollar is also strengthening as price is starting to break below the 4-hour consolidation areas. So that was a key level where price was sitting at yesterday, and we wanted price to break below it and then a continuation down. Yesterday I mentioned that I was going to do the analysis with you guys in the live session today. So this is what we're looking at, where even on the daily time frame, price is starting to break the previous lows, which was the previous resistance areas here. Now, as Euro USD is continuing to fall here, the next area of target that I'm looking at, come back to the 4-hour, is going to be, now you're basically entering into all this consolidation, but it's going to be to come back down into 1.62 area, 1.63 area. So can the dollar strengthen enough where the euro continues dropping back down, or are we just going to end up creating a bottom wick and then a flip back up? GBP USD. So for that to happen, you need the dollar to strengthen and the yields to continue pushing. With GBP USD, quite a similar setup, but we already got a 4-hour candle closure. Below the zone of 1.362, you got a new 4-hour candle that's starting to push back down. So can price continue breaking below this? Anything in between is going to be a no trade zone. But if GBP USD can continue breaking below that level, then we have those nice sells to come all the way down here. That's going to be the first target. The next target after that is going to be 1.35. If price simply makes a bottom wick rejection or holds onto a support and then pushes back up, then you have cleaner buy opportunities that are setting up to continue breaking past this consolidation. That could be your first target on the 4-hour, that consolidation resistance, and then up into 1.37 area. Nasdaq was already down this morning. We saw a little bit of a wick rejection and then a continuation back up. But right when New York Stock Exchange came around, this is where the data was released. Right when the New York Stock Exchange came around, we started pushing back up. I am still waiting for price to get out of this consolidation for a longer term trade, but purely based off of some scalping opportunities. Currently, you're sitting in the middle of a range. What I want to see is going into the next couple of hours. In about 25 minutes, we're going to get some crude oil inventory data coming out as well. But this is coiling for Nvidia. If there's one index that is going to be most impacted by Nvidia's earnings, it's going to be Nasdaq. After that, it's going to be the small caps, and then after that, it's going to be the US 30. So this one is coiling. If you can stay away from Nasdaq today, I would 100% do that. And then wait for your price break above the 29,400, which is the immediate resistance, and the support of 29,000. If price heads into any of these directions, your first target coming down is going to be closer to that 28, almost 750 area, and then a continuation down into 28,400. That happens if Nvidia completely misses either the earnings or the estimated revenue, or if the forward outlook, it's not seen as strong as the market was really expecting. But if they're completely, it's going to be another blowout earnings or anything like that, then you can expect that Nasdaq will continue pushing. Yesterday, I also mentioned in the market update that if we have an amazing earnings coming out from Nvidia, but Nasdaq does not react, then that is additional information. So we're going to look at that in today's market update in Asian session, because that means that the market is preparing for something else and it's putting on protection or hedging for an additional catalyst, which is going to be the Jackson Hole Symposium. With the US 30, same thing, sitting in that consolidation. But this one is least affected by Nvidia's earnings. It is still going to be somewhat affected, but not as aggressively as Nasdaq is, because US 30 has a lot of different sectors, the industrials, it has financials, it has the defense, the energy, it has obviously some tech exposure, but not like Nasdaq. So this one is going to be a little bit more of a cleaner move as long as price can break past this 4-hour consolidation that we're looking at. Small caps is also coiling right into that weekly consolidation or that resistance area right up top here. And then same thing on the daily time frame. So right into the previous daily resistance, that's exactly where we're seeing that consolidation. So for that, I want Russell to drop below 3,000 or above 3,020. And then the next target here is going to be that 3,040, then coming up into 3,070. If we can see that there's a lot more of a risk on sentiment in the market compared to Nasdaq and even US 30. Coming over to gold now, we have pushed up, tapped into that 4,700 mark. In the market update, I mentioned that I wanted a sweep of 4,600 and then a continuation back up bullish. If you come down to the hourly, the last hourly candle closed strong bullish, not really breaking the previous highs, but close at the highest level that it could. The main area that I'm looking at for those continued buys is waiting for price to continue closing above this area. You got a new hourly candle that started forming about 10 minutes ago. So I want to see the 15 also closing bullish in the next 5 to 6 minutes, and then a continuation back up. If you cannot do that, then there's a very high chance that we're going to continue consolidating right below this level here again. So looking at all of these all across the board, it's not random movements per asset. It's not random movements, from yields to equities to currencies to commodities. The market is basically saying that the Fed may not need to hike in September, but this report did nothing to take another hike off of the table either. So the hike probabilities actually rose after the release. So today's PCE print did not give gold and Nasdaq the rate relief that they wanted. So that's where we're seeing a lot of that consolidation. We want to make sure that we're not getting stuck in any fake outs either. All right, so we're looking at the next tension, which is going to be the Treasury versus the Fed. So in the market update again, we're looking at the article that was called the best put. Let me actually go ahead and pull that up here too. Actually, that'll find it easier to pull that up. The exact article that I want. Alright, let's pull up. Any questions so far? Alright, here it is. What the market is basically calling a best put. So this is something else I went into detail with in the market update yesterday. But the next tension now for the market is Treasury versus the Fed. So the Treasury has expanded its long end buyback program that created a genuine technical bid for bonds last week. The yields fell, bond option skew became more bullish. Short sellers had to respect the fact that there's now a bigger government buyer in the long end market. In the near term, it's not that the best and twist is not bullish bonds. I think that's too categorical. In the near term, it has been bullish bond prices. If Treasury becomes a larger buyer of long duration bonds, that is mechanically supportive of those securities relative to the counterfactual. But that doesn't mean that the structural bond bull case is basically now solved. The fiscal problem is still there. The deficit problem is still there. The issuance problem is still there. The term premium still remains elevated. So the real thing that we're looking at is from the tactical side, buybacks are supporting long bonds. From the structural side, the debt supply and inflation pressures can still push long yields higher. So both can be true simultaneously that we're looking at. Now, this is the next thing. If, like I said, I'm not really expecting that Kevin Warsh is really going to be saying a lot or really giving the full guidance or an outlook or any sort of hints like that towards potential hikes that the market is really expecting. But if he comes in line with, exactly that, basically saying that, there is going to be nothing happening in September. And then for the future, towards the end of the year, if there's any questions regarding, if there's going to be actual hikes, what is the Fed expecting to do with the Treasury, this and that, whatever. I'm expecting him to say that those are independent agencies, the Fed from the Treasury, and that the market is going to be pricing in real time whatever ends up happening. He's not really going to give us much. So as that happens, the next key thing that the market's going to be looking towards is going to be the Treasury basically still being on the edge, because Treasury Secretary Bessent has already made a plan that he is going to increase some more of the buybacks and things like that. So those are some of the key things that we're looking into. Now, Jackson Hole is going to happen on... It's going to start tomorrow. Friday is going to be the important day for us because that's where Warsh is going to be talking. You also have consumer sentiment, inflation expectations, and then Saturday is where the Jackson Hole pretty much ends out. Warsh's debut at Jackson Hole appearance is still ahead of us, with the market basically just waiting for his speech on Friday. And right now, the investors are still waiting for Warsh to clarify his policy strategy at the symposium. So do not build a trade around a speech that has not happened yet. We're not trying to predict anything. I think personally, just given all the data points that we have, every time that Warsh spoke in the past, everything that he has said, that's what he's going to end up saying. But that does not mean that I'm just going to jump into trades right now and then try to like swing trade through that event. That's the wrong way to approach it, because there's going to be a lot more volatility, especially as investors are hedging heavily right now, waiting for Nvidia and then also waiting for what he ends up saying. This is exactly why, we're looking at the options data as well from yesterday. We looked at the raw options data. We looked at what the institutions are doing versus the opportunities that the retail side is getting out of. The reason why gold is also one of the best trades that we have seen, and we have been seeing for almost 2 weeks now with Transpider, and a lot of it is being used as a hedge at the moment. So what Warsh has to address on Friday now is, before today, it was already facing 3 problems. It was sticky inflation, a divided Fed, and long-end Treasury instability. Now, today's PCE and GDP gives him a little bit more of a specific setup. With inflation, its core still at 3.3%, headline at 3.7%, both of them still above target. Growth, with headline GDP only 1.5%, but private domestic demand sitting at 4.2%. In terms of financial conditions, the long yields still remain extremely high even after the Treasury support. So Warsh has to communicate where he thinks that the tightening is already coming from. If long-term yields are already imposing restrictive financial conditions, then he could argue that the Fed doesn't need to hike aggressively. But if inflation remains sticky, while the domestic demand stays strong, then the argument for another hike still remains alive. So that's the tension that the market wants Warsh to resolve on Friday. And then for today, we have Nvidia, which is basically they're going to have to fight the discount rate. Nvidia reports after the market closed today, and today's macro reaction just made that report a little bit more important, because yesterday there were 2 possible tailwinds for tech: a cooler PCE print and a strong Nvidia report. We did not end up getting the first one here. We got sticky headline inflation and higher yields. So now Nvidia has to deliver enough earnings growth to overcome a slightly higher discount rate. So that raises the hurdle for Nvidia today. Like I said, it's no longer about just hitting the estimated numbers or the forecast. It is more about, can they go above and beyond and really have an amazing earnings and really show that there's a lot more growth that's happening. So what the market is already expecting from Nvidia is that Q2 revenue consensus is sitting at 92.18 billion. That's nearly double the year earlier. Forward Q3 revenue consensus is around 104.2 billion. Gross margins are expected around 75%, and even the options data that we looked at yesterday, they're showing or implying roughly 5.4% post-earnings move, which is actually below Nvidia's historical earnings move of roughly 7.4% in the past 12 quarters or so. So the market is already assuming and pricing in excellent quarter, excellent demand, excellent margins, excellent forward growth. So that is why a simple beat is not going to be enough in the current market. All right, let's come back here. So we got a 15 close below the 46.24 area. Most likely we're probably going to end up getting consolidation. I'm going to set an alert at 46.30. If price can break past that, then our first target is going to be to come into 46.45. After that, it's a clean move all the way up into 46, almost 70 areas, 65 areas. So that's going to be the next target point. I wouldn't be surprised if price continues to consolidate here until Nvidia. US 30. We have this 4-hour consolidation, so I actually want to see a full push. Even the previous 15. Let's actually go ahead and map out that zone real quick. Even the previous 15 could not close below that area. So this is where the consolidation support is sitting on the 4-hour. I want to see clean candle closures below this and then a continuation down. So the first target can then be 43,400. And then after that, 53,400 and then 53,300 coming all the way down here. So this is going to be the first target, which gives you a range of about 124 pips and points. So if price continues dropping, this could potentially be a sweep for a longer term trade to come back up from that 53,400 to come back up into 53,750. So that's a 350 point move to the upside after a nice sweep down here. So the reason why I'm looking at a sweep is because we have gotten wick rejections here yesterday as well, and then price push back up into this consolidation. Also, just from higher time frames, you are still in this massive bullish volume to the upside, and this is more of a corrective move. So on a daily time frame, that would give us a bottom wick right into that 53,400 and then a continuation right back up for the next couple of days into the 54,000 areas. So this is the type of New York session where you're not forcing any trades. You're not just trying to jump into something just to squeeze a move out. You're waiting for the data points. The market is heavily hedged against all of the high impact news that's about to come out, especially ones that are impacting every single asset that we're looking at. So nothing that we looked at today is an independent trade. Everything that we looked at is a byproduct of whatever has happened in yields in the bond market, whatever's happened with oil, inflation, all that type of stuff. So we're going to wait about 9 more minutes. So let's prep for Nvidia now, looking at the different scenarios. All right. Nvidia reports tonight, post-market, and this is going to be the binary event for Nasdaq. And then also reporting tonight, you have CRM, Crowd, and you also have Marvell tomorrow. And then here are the different scenarios that we're looking at. I personally would want, in scenario 1, more than a $92 billion beat on the revenue. I want the next quarter guide convincingly above the 104 billion bar that we have. And then we also want strong Rubin commentary. We want the margins holding. We want the hyperscaler demand intact. And we want no deterioration in China guidance. If we get all of that, then Nvidia should rally. SOX should confirm. AMD, AVGO, MU, ANET should participate. And then you have NQ or Nasdaq. But now there's one extra requirement. The 10-year yields cannot be ripping through 4.7% at the same time. If Nvidia beats massively, but yields keep rising, then you get Nvidia that's going to push up. Meanwhile, Nasdaq is still going to underperform. So company fundamentals versus index valuation is what we're going to be looking at. That would be one of the most important divergences of the entire week that we have. Our second scenario is you get a good quarter inline guide. So that remains as the biggest retail trap. Nvidia, for example, let's say it beats the EPS, it beats revenue. TV headline tells us Nvidia beats again. Stock initially spikes, and then the market asks, "What did you tell us about the next quarter?" If guidance is basically what everyone already expects, then the first move can fade out. So that's going to be especially true today because the discount rate is already moving against tech. So a strong quarter plus an average guide plus higher yield, that is still going to equal a bearish Nasdaq reaction. Our third scenario here is a miss or a weak guide. So this is not just going to be Nvidia. The market is immediately going to ask, is the entire AI capex cycle now slowing down? So then the transmission goes, the chain that goes, Nvidia is going to drop, SOX is going to drop, AVGO, AMD, MU, ANET, these are the biggest ones that are going to be impacted. They're going to drop. Nasdaq is going to drop. And then data center and power infrastructure potentially is going to get repriced. So now that becomes a sector-wide earnings reset instead. Our fourth scenario is the real tail risk here, which is going to be our demand quality. So this is a scenario that I care about most conceptually. Nvidia may still report excellent revenue, but if investors begin questioning how much AI demand increasingly depends on financing support, vendor guarantees very aggressive hyperscaler capex and customers' earnings insufficient returns on that capex, then the market may lower the multiple it pays even without an earnings collapse here. So now that becomes a valuation problem, not an earnings problem. So those are the couple of different things that we're looking at here, and China revenue and Blackwell supply chain commentary are the micro catalysts inside that number. The next buyback operation for the Treasury is going to happen on September 9th. So continue watching that too. The 30-year yields at the highest since 2007. Last time we came back to these numbers was around 2007 here, June. Another thing that I meant to go deeper into was going to be the Strait of Hormuz. So here it seems like Iran and Oman have agreed on their respective shares of the Strait's waters and how revenues connected to the waterway will be divided. So yesterday we were just looking at interim deals basically that were happening, conversations that were happening. We finally got the full confirmation here, because now we're moving away from, we're just talking to some of the economics and governance structures are actually being negotiated here. So that is a lot more important. Iran itself says that a navigation deal with Oman does not mean immediate reopening. The US has not agreed to the concessions that Iran wants. Iran still wants sanctions relief. It still wants restrictions in the waterways removed and frozen assets addressed. And shipping is still very tiny relative to the normal, unlike whatever we're getting from Trump here. We got confirmation that only about 5 commodity vessels have crossed Tuesday versus roughly 15 on a more typical recent day. So that is actually far below pre-war traffic too. So continue paying attention to the actual physical movements rather than just the headlines here. Let's come back. We're about to get a 30-minute candle closure here soon, and we're about to get oil news as well in about a minute. You guys have your alerts set? Any questions? All right, for US 30. I'm going to set my alert right below the 53,400. I'm going to continue watching this. I want to see a sweep here and then push right back up into 53,500 and then a continuation up into 53,750. Those are the buys that I want to see. If price breaks below this 53,400, it will be breaking the previous daily lows as well. So those are bigger sell opportunities to the downside that I would be willing to catch. With Nasdaq, we are still consolidating on the daily time frame and even on the 4-hour. Pretty big range, but I'm going to wait for Nvidia's earnings before I trade this one. And same thing with small caps. Now with gold, I'm going to set my alert right underneath 4,600, so then we break below these major support areas. After that, I'm going to be targeting coming down into 45.60 area, and then after that, it's going to be the 45.40. So why specifically those? 45.60. If you zoom out and you look to the left, that is cutting through right into those previous resistance areas and support areas. So that's going to be my first target. If gold can continue dropping below the 4600, if it flips back up and it pushes back above 4620 area, this zone, and then comes right back into that consolidation, then I have a much bigger range to trade to the upside. So that's what I'm going to wait for. Silver's going to follow exactly what gold does, so we're good there. And we're going to continue watching the yields and oil going into the end of the week. So make sure you guys have your alert set. Make sure you guys fully understand the fundamentals behind the moves today. And that's pretty much it. So I'll see you guys for our market update later today. Have a great rest of the day, guys.